Welcome to your Weekend View, where we bring you the latest insights and trends in real estate investing. I'm your host, Daniel Brereton. If you're an investor, you might have heard of something called dollar cost averaging. Basically, dollar cost averaging is a way to average into an investment over time. You want to invest right now, you want to be making sure you get those good returns, but you also might want to hold on to some cash in case there's a market drop or in case the stock goes down. Dollar cost averaging can help smooth out those returns over time and smooth out the price that you pay for a stock investment. However, in private markets, there's not the same up and down of the market that you might see in stocks, and it's particularly in private market CRE offered by EquityMultiple, the prices don't fluctuate. Still, while this can help your portfolio to smooth out and not have as many ups and downs, you might not know when the proper time is to invest in the private markets. A lot of investors that I've spoken with, they see a deal and they want to invest all their money all at once. And obviously, if it's a good deal, you want to be getting into it. But there are deals that look like sure things. I think it's still important to keep a long-term view and a long-term perspective in mind. Diversification is one of the best ways to help your portfolio. And it's not just diversifying your portfolio across several managers or properties or strategies. It's also investing and diversifying across time. In private markets, there's something called vintage risk. Even though private markets can be decorrelated from the public markets, there are still real economic drivers that affect the returns. So the time that you invest in the economic cycle impacts the type of return that you get across the cycle. In order to impact those returns, you see different outcomes when you invest across the cycle in private markets. The vintage or date you invest in private markets matters. To dampen this risk, you can consider investing over time or across the cycle. That way, you're getting smooth performance across time. Sometimes you invest at the high, sometimes you invest at the low, but as you invest across the cycle, you're getting the average return and you can potentially get an attractive return versus other investments.